Hey everyone, Michael Beresford here from OpenCorp. I'm here with Al Lewison and Cam McClellan.
Hey guys.
Howdy guys.
We're going to have some fun tonight, everyone. You've got about 60 years of collective property investment experience here to answer all of your questions. So we're here for you guys. Please open the chat bar, flick the questions through. We'll have a ball and give you some really good detail. This is the first of our Q&A sessions with OpenCorp. We want to make it a monthly thing. We're kicking off with the three of us tonight, and we want to make it really beneficial for you. So fire away. We look forward to getting all of your questions through, and we're here from you.
While we're waiting for those, I think 60 years is probably, you've been a bit tight on us, probably 75-ish or plus, but
apparently I'm older.
Bring everyone up to speed. I was saying to the guys, I had a really, I had a meeting today with some really senior people in the bank, and they're looking forward to on Friday when the new house starts metrics comes out on Friday, and there's some concerns there that due to the reduction in housing starts, due to what's happening in the credit markets, that we're going to be headed toward a rental crisis. And maybe just while we're waiting for the questions, we thought we were talking about what does that mean for the broader property market, guys, in your opinion?
I was looking, and I'll let Michael answer it because he's a stats guy, but I was working through with Matt Lewis and one of our business partners and fellow directors through the analytics out of a investment committee research that we do every month. So it was basically a pod, and we were looking at a number of different markets, and it'll come out, I think they're filming it tomorrow, so it'll come out in the following week, but it was looking at the vacancy rates, what happened to price growth following those vacancy rates when it gets to a certain tipping point on vacancy rates. So, hence what the bank guys are saying to you. Al, what bank are they from?
Westpac today. Pretty senior guys there. But, yeah. Vacancy rates in the rental market anyway. So, Boz, what will happen there? What do you see happening? Who's going to come into the market? What will start to drive things from where we're at?
Yeah, I think it's a really good example that everything cycles all the time. So whether it's capital growth, rents, is trying to drive us out due to the tough lending restrictions. And no doubt first home buyers will be coming back into the market as well. So if we think about the basics, if you're paying whatever it might be, $400 or $500 a week in rent, and all of a sudden due to lack of building activity, you can pick up good deals and be paying the a couple from Caesar's just giving us the heads up. Caesar's also fired through another question. Thanks for joining us, Caesar. With the award for most active.
I should point out that the single camera that's on Boz is only to pick up his watch. He just wanted to show everyone his watch.
And the new hairstyle, he's combing the other way now.
This is pretty good. It only took 4 minutes for you guys playing into me, which is normally it's within the first 30 seconds. So
what was Caesar saying?
Caesar was saying that starting to get some good interaction here. Let me just scroll down. Here we go. Could the panel detail Cam's comment in the Twitter 2019 WAD preview how population growth in cities has changed?
Population growth in cities has changed. All right, I'll try and keep this to under a 10-minute description. Under cities have changed, right? So really quickly, going back 20 years ago when Al and I started investing, and how long you investing was?
16 years.
There you go. Yep. So thereabouts 20 years-ish. There was capital cities, and everyone basically we looked at the distance between the capital city and the area we were investing in, and I'd look for large portions of land or large potential supply to come onto the market that may douse the long-term or the short-term to medium-term growth of the area that I wanted to buy in. And that was a pretty easy formula to follow. We used to literally just draw do a dot in the area and follow missing water, of course, the distance between to the capital city, and just look along those lines. The reality is Australia is trying to recreate. It's tough without a whiteboard, but I'll go through it. Australia's trying to recreate what's occurred overseas naturally over the last few hundred years. So if we think of London, for example, European cities, the way they developed was literally they get a capital city, and then how far you could travel with horse and cart. There'd be a small village would set up, and then how far you could travel with horse and cart, another village. So there'd be all these little villages all set up all over the place. And then as time progressed, decades and decades and centuries progressed, all of that infill would build up. So you've got major capital cities, and people who've travelled to, I'm using London as an example, but lots of European cities are the same. People don't tend to travel too much around England. You know, they'll stay in their local area and that's it, because they've got everything they need. In Australia, when we developed our capital cities, we had the motor car. So we'd get to the city and we'd tear out to the outer suburbs and we'd set up homes. And then we could drive into the city, and all the employment was in the city, and everyone transferred back and forwards. The government, and excuse my French, the government are very scared, I'll use nice terminology, but
that's not French.
Are very, very concerned at this point in time. And we know the old adage that everyone's using, the baby boomers are exiting the market, so taxation dollars are going to drop down. We haven't got the dollars to be able to fund the infrastructure to live on the outer suburbs like we used to and travel into the city. So as you know, in all capital cities, our roads are terrible, rails underserviced, so we're starting to get that pressure build up. So what the government did a number of years ago is put the urban growth boundary on, which is on the outer side of our cities is rural to metro. The inside our cities, it's high density to medium density and even low density. And what the government have planned to create is basically what's occurred naturally overseas over the last 2 centuries, and that is creating small business hubs all over our capital cities. Now, Melbourne, we call them activity centres. The different capital cities have got different terminology for them, but basically they're small business hubs, small economic villages where people can live and service that local area. Now, I was looking through, there's a website, and forgive me, I'll post it up, make sure I post this up, which you can basically look on. I was looking at it yesterday with Matt, and you can look at each council, and you can basically tell the exact percentage of where people live. So we're looking at Casey and a couple of different other councils, and we're looking at, what was it? It was only a small percentage, like 7% of the people from Casey work in the city now. So what the government did a number of years ago is they pumped out the ATO, and they pumped out a lot of government offices to those outer suburbs so that the economic hubs would be there. So did I do that in under 10 minutes?
Just on that. So a great example of like how everyone thinks about what happened yesterday and what might happen tomorrow, take a relatively short-term view. If we take a long-term view, I remember having a coffee with a client of mine at the time who was a town planner at the city of Casey. This is 2010, and he said to me that, he said, Michael, the goal that the city of Casey have is to have 40% of the residents of the city of Casey working in the city of Casey by 2025.
They've smashed that. That's more than that now. Way
right.
more than that.
And 9 years ago, that would just seem completely idiotic. And they've still got 6 years to go, and they've well and truly smashed it. So, we do all get stuck into politicians sometimes, but I think we design, good cities, and all of this stuff is well thought through.
Oh, and I think as technology is getting better, and some of the stuff we're looking at in terms of investment properties, and as Cam said, you used to look at it 20 years ago and say, what's a direct line from my property to the city, and are there infill areas that can price me out? Now we're looking at data like, what's the average drive time or commute time for people from their house to their employer? And we can start to get that data based on a council like City of Casey. Average drive time is 23 minutes, average commute time is 28 minutes, things like that to start to factor in what's going to make the ideal investment property and get growth in certain areas. So as technology is getting better, those things are becoming available, and they were starting to factor those into, and we're looking, I guess, going forward, making them a big part of what our plan is going forward.
Yeah, awesome. Going through a very painful process at redoing the current the copy within the book that we've had for now, 2010 it came out. So yeah, trying to recreate that based on drive times and things like that, because the way our cities are developing and how they're going to develop in the future based on population growth forecast, and the way our cities develop is a lot different.
My 30-year-old, the property investor.
There you go. There you go.
We've had Adrian's joined us, Kristen's joined us. G'day, guys. We're growing in popularity and ticking up there in terms of views, which is making us happy.
Can you see where people are from?
What's that?
Can you see where people are from?
Maybe, but I'm not that smart with Facebook. What I can see, Adrian's got a question here. How far does the Sydney market have to fall before it bottoms out?
There's a couple of factors in Sydney at the moment, if I jump in there, guys. One of the big ones that's causing some problems is that their rental vacancy rate is drifting. So we've seen it over the last few reporting cycles creep out further and further. I think it's out to 3.3% now as a rental vacancy. We think it will keep creeping out. So what that means is that there's excess property in the market. There isn't the population growth or demand to fill those properties. So a surplus of property effectively, which means the market will remain flat. I personally think it's going to remain flat for a little while, and we need to see those numbers start to trend back down. Because when you're going to start to see growth in any property market is supply and demand. When there's undersupply and over demand or increased demand, we're not seeing it in Sydney yet.
Yeah. I'd probably just add to that by saying that one of the main indicators that drives growth in markets clearly is population growth, and specifically net interstate migration. So two things tend to drive net interstate migration, and for those of you that aren't aware what that is, it's basically people moving interstate within Australia, a net number being positive versus negative. So at the moment, Sydney is clearly the most negative of any of the capital cities. Job growth is okay. It's well under other capital cities based on the size of that city. So not strong relatively, but obviously affordability, which is the other factor that drives that, is not great, given that it's been through major growth phase 13 to 17.
Yeah, we've seen obviously people want to upgrade their primary place of residence, and we've seen a lot of this occurring over the last and strong trend now, which is we've been waiting for a while for it, is that transition from people migrating from Sydney to Brisbane, that's pushing hard there, because you can get, I think there's 3K difference in average waves between Sydney and Brisbane, but it's nearly half the property price.
Well, we've got I don't know whether you guys are aware, we actually got 6 clients that are doing it right now. So since we started talking about Nick and Annie, yeah. So some of them are in the process of selling, some of them have already moved. But the consistent, on the 3 that have moved already, the consistent theme is that they've netted several $100,000 in cash by selling a house in Sydney, buying something equivalent or nicer in Brisbane, and all 3 have got pay rises in the process.
Yeah, nothing in Sydney, but if I was moving from Melbourne, I'd be going to Brisbane basically. It'd be that'd be the next choice. The lifestyle.
And last time we saw great growth or significant growth out of Brisbane, that started with that. It started with the discrepancy between Brisbane. It started with people moving to Brisbane for those reasons. And it started with the market starting to take off from there. Yeah.
I think Caesar was very impressed with your answer about how capital cities were
Sorry, I had no
were rolled out.
So, I was trying to keep it short too.
He said, outstanding answer team, thanks.
Good on you, Caesar. Glad we could help.
Well,
give us some more. Come on.
He has. Caesar, not to hog the question stream, but wondering if the panel have any insight into... Oh, here we go. It started. It's flowing. Have any insight into the impact on investors from upcoming election results? Excellent. Very first question we got emailed through this afternoon.
Boz, you want to kick that one off?
Yeah, I thought you'd never ask.
Boz is our political reporter.
Michael Beresford here, political correspondent for OpenCorp. So there's a couple of things. The election itself, the fact that an election is happening will have minimal impact on the property market. Guaranteed, come Monday the 20th of May, the sun will come up. The people will be going to work. Most people have probably forgotten who they voted for, and the wheels will keep turning, right? I think specifically what Caesar's question is getting at is related to Labor's negative gearing policy and capital gains tax policy, I would assume,
they're the big hitters,
given they're the ones that are probably going to affect the property investors the most. In effect, so what I might just do is recap what the policy is for those that aren't aware. So the coalition will keep everything as is, and Labor have basically said that for any established property that's bought as an investment, the negative gearing benefits won't apply from January 1st, 2020. Okay, so to be really clear, any new property that is acquired will continue to get negative gearing benefit. It's not wiping negative gearing out across the board. And there is a lead time for them to be able to implement that policy through Parliament. So that's basically what the policy means. They're also talking about cutting by half the capital gains tax.
So do you want to explain that as a 1 year and a pre-1 year and a 1 year ruling? So how much capital gains?
CGT, capital gains?
Yeah.
Yeah, okay. So at the moment, you basically get a 50% discount on the capital gains tax applied at the marginal tax rate. So let's say that you, rough example, but to explain the concept,
example, yep.
Let's say that you bought a property for 300 grand, you sell it for 600 grand, the capital gains 300. You get a 50% discount on that, so you only pay capital gains on 150,000 at whatever the marginal tax rate is. So if it's 40%, then you're paying 60 grand in capital gains tax.
Yep.
Okay. That's hard on the fly at 6
If
o'clock
anyone's
at
got
night.
any complex finance questions, I want to send them to Michael. Let's see if we can stump him.
While I was on track, so basically what Labor have said is that discount will come down to 25%. So do the adjustment. Long story short, you'll be paying more capital gains tax if you sell investments. And it will make tens of thousands of dollars worth of difference depending on what the capital gain is, obviously, on the asset. So if we continue that train of thought and talk about CGT first, what it will discourage is selling of property.
Yep.
Right? And for some of you that might have seen our WODs, I've been pretty consistent in our commentary that I understand what Labor are trying to do, but I don't think the policies that they're promoting are going to achieve desired outcome. And the reason for that, one of the main sources of revenue that governments have is obviously stamp duty. And if you start decreasing the amount of property sold, that's going to have a pretty heavy hit on the government's bottom line and the revenue that they generate. So that's the CGT part. From a negative gearing perspective, because negative gearing and tax benefits will remain for new property, I think naturally there'll be some people out there that just invest to get a tax benefit. And that will drive them into newer property. So again, supply versus demand. If less property is being sold and more demand is coming into the new market, we'll start to see prices increase and more competition in that sector of the market as well, which, for those implementing that kind of strategy is going to be a good thing.
And I think CGT is one thing, and I think every government's got their way of getting a bit of extra tax. The negative gearing component, I think, and I'm not getting political whatsoever. If my grandma's watching, I'm voting Greens, because if I say anything different, she's going to be into me. But we don't want to get political in this as far as who we prefer and what policies we prefer. But the reality is with negative gearing, a lot of people think negative gearing is used by the rich to make themselves richer and more everything. None of us use negative gearing. Our portfolios have been positive for a long time. The majority of people, I think, and I don't know the exact stats, but I think the majority of people, the very large majority of people, it's about 80% earn under 120k who actually utilise negative gearing as a household combined income. So I'm not 100% on the figures, but it's a very low percentage of wealthy that use negative gearing at all. So it was really designed. Do you want to give a quick snapshot of why it was designed?
Oh, it's really. So my attitude on negative gearing is that basically if people are motivated to improve their own financial situation and long-term become a self-funded retiree, negative gearing is basically giving you an advance on the pension, right? So you're not going to be a tax burden on the government later in life, so they give you an incentive to basically invest now and create your own financial scenario.
Can I ask another way though? Like my take on negative gearing is that it's the government encouraging us to provide affordable housing.
Yeah, correct.
Yep. So off the back of the government saying no negative gearing on used property, let's call it, well, the rents need to be higher to make it appealing for an investor. So if the rents need to be higher and people are buying a property with higher rents, that makes it less affordable for someone to live in it.
Yep.
So I look at the policy and think, well, why would Labor, for example, say we'll just do it on new property? Well, they recognise that the property market is a major employer in the country and they need new property to be fueling the jobs and supplies and all the rest of it to go with it. If I break it down the other way and look at the capital gains tax deduction, I can't see what they're trying to encourage. I might be missing it, but I just can't see what they're trying to encourage. Maybe it's a grab.
There's no doubt that that's just my concern with negative gearing and removing it is I love Australia, and I think we're the luckiest country in the world, the way our community is mixed together. The haves and have-nots are all mixed together, so we get this, Australia's got a really good culture to it. The issue that negative gearing overcomes is what's occurred in the US, where they need to provide large-scale affordable housing. So they've got an affordable housing scheme in America. So they build huge buildings to house people, and they provide that as affordable housing subsidised through the government.
We're going to say slumlord?
Or what we know, America's affordable housing is ghettos. So we didn't want ghettos in Australia. We wanted everyone just to be equal through Australia, living together and having really solid community. So we provided negative gearing. So in a primary place of residence can have a rental property next to it, people can live together and everyone's happy. If negative gearing removed, my main concern is that the government's going to have to step in, provide affordable housing, and you're going to get big slums popping up all over the place, which destroy our culture.
Sure. Yeah, we've had a few extra people join on. Ramjet, love the name, love the Sunnies. Yeah, thanks for joining, Tanya. Michael's got a good question. Who has the bigger guns out of Al and Cam?
That's pretty easy, isn't it?
So, given that we've solved world peace in 2 seconds flat, Miles, welcome, Miles. Miles had a question that just dropped off the bottom there. He said, "What does depending on the outcome of the election, what does the government have to do to maintain buoyancy in the Australian property market?"
Buoyancy in the Australian property market. We'll talk about the levers that they've got in the lending criteria.
That's the big one.
Yeah,
so there's been some articles recently, and I read a full-page article in the paper on the weekend, and it was about how.
Papers for? Jesus.
And it was about, which part of it made sense, but the only bit that I actually thought was relevant was the last 6 words, bottom sentence in the whole article, and what it said was, there's talk of the RBA wanting the banks of reducing interest rates. Will the banks pass it on? What happens if they do? What happens if they don't? Lots of debate either way. The last sentence was, it doesn't matter what they do because there's a credit crisis and no one can get money. That's what's holding everything back. So you can call it what you want. Until there's some flexibility enabling people to get their hands on credit, the property market's going to sit where it is.
It's a strange environment at the moment, and we've Michael and I talked about this. So the reason that the property market actually tapered off at the moment is the first time that I've ever seen and can look back at over the history of well beyond my birth date and look back at the reason that the property market
1924.
Yeah, very mature. Benjamin Button. But every other economic crisis which has affected the property markets has been, I can't say non-man-made because they're man-made, but they're not man-made in purpose. So expand on a few of those. So what I'm saying is, all right, if you look at the GFC, man-made but not on purpose.
I'll ask the question.
92 recession.
I'll ask the question a simple way. If you could have bought a property wherever you lived 30 years ago, would you do it? I'm yet to meet one person that says no, with the benefit of hindsight.
Yeah.
If we go back to late 80s, since that time we've had the recession.
92.
Just before that, negative gearing was taken away. Negative gearing came back. Asian financial crisis, stock market. I didn't hear that. Stock market's like 60% of their time.
Just heckling you.
60% of their value. We had the GFC. We had September 11. If a market crash was going to occur, it would have happened with one of those things. We haven't got any of that kind of stuff happening at the moment. What we've got is a tough lending environment.
Someone put it to me, we've got an out-of-cycle property correction. So historically, when you look at a correction in the property market, it's due to oversupply, high interest rates, things like that are slowing the market down. Right now, historical low interest rates, extremely low vacancy rates, high population growth, high demand. The difference is, quite literally, that people are just having trouble accessing credit to make property purchases.
Yeah, and the banks want to give money. They've just been told not to. And they just have to slowly creep the... what was some of the talk today? Who were we talking to? The calculators. Was you talking to Tom Colley from CK Finance about the lending calculators getting adjusted again?
It wasn't that conversation, but clearly the same conversations are kind of happening with similar people. So what I've heard is basically that the government's realised that they, or APRA, and the banks have all realised they made a knee-jerk reaction. They're thinking about making more tweaks to make it a controlled recovery as opposed to flipping it back straight away to what it was.
Just turn the switch on.
And just for viewers, do you want to explain really, because people say it's tough to get money. It's not the matter of that you haven't got enough equity or money in your back pocket to buy a property. It's that you can't service it, and how with the 1-2 on
and probably why an interest rate cut doesn't actually doesn't actually do anything for people based on
cool.
Current
Really,
rules.
really simple. Whether the interest rate that you're paying on your mortgage is 3.5%, 4%, 4.5%, doesn't matter, because if you are trying to either refinance and or get access to new loans, banks are assessing your repayment rate at anywhere between 7 and 8%. So everyone, for all intents and purposes, may as well be paying a 7% interest rate in the bank's eyes when it comes time to trying to get new money.
Yeah. Yep. And they're looking at your expenditure in real dollars.
So just to quantify that, right? Most people are being calculated on double what they're actually paying. So let's say, let's say a mortgage of 500 grand, your monthly repayment, principal and interest is going to be about 3 grand, let's say. So if the bank is assessing you at 6,000 a month, then that's an extra $36,000 a year
after tax
that you've got to have in post-tax money to be able to get that. So think about 36,000 post-tax is about 50 grand pre-tax. So think about how long it takes for your income to grow by 50 grand. That's why there's been such a constriction, because that's a massive difference.
So you can see now why I'm saying it's a man-made property flatten, as opposed to, because we've got an undersupply of property and a population growth forecast which is still squishing each other. The reality is people just can't fund it.
What else we got, Boz?
So there's a couple of questions here from Ramjet and Michael talking around the same kind of thing. So are we heading for a recession or is it a correction? And further to what we were just discussing, any insights into when banks might be reducing or relaxing their servicing calculators?
Predicting a recession is really tough. It's definitely not a correction, because the market would have kept bar Sydney probably, the market would have kept ticking along nicely. Melbourne wasn't on some sort of steep incline. It was just on a nice pressure on supply increase.
As Boz said just moments ago, in terms of a controlled recovery, so two of the big four banks, so two of them through discussions in the last fortnight, I guess, what's come up is that they're pushing very hard on APRA to reduce the buffer that is being applied to people when they're doing a loan criteria assessment, and they're talking if they can bring that down by 0.5% from the 7.25 currently?
Generally, yeah.
All right, down to 6.75. That opens up 10% more buyers into the market who have access to money. So all of a sudden, you start to see that money start to flow slowly back into the market, not driving us straight back into a boom, driving into the market slowly, and that recovery will start to happen. So enormous pressure currently from the big four into APRA, into the regulators, to start to allow some of those things to happen from what we're hearing.
So what was the question was a correction, whether we're going to recession. There was a third component, was it?
When might the calculator relax?
Calculation, right, cool.
Yeah,
I think we covered that.
So not that we've got a crystal ball, but we actually held a webinar for our existing clients at the start of the year, given that the landscape in 2019 was pretty different to what we've had for the previous few years. And I got asked for some crystal ball projections as a bit of fun. The first one that I said was, I reckon that by mid-year the servicing calculators would start to relax. Give it 4 to 6 weeks after an election. We're not there yet, just so everyone knows, it's on the record.
On the 2nd of May, I think.
I thought that they would start to see them easing up kind of mid-year.
Okay.
So I think on track for that at this point, based on everything that we're hearing.
I shouldn't be asking the questions, but I've got one. So if I talk to real estate agents, they're hungry. They're very hungry at the moment. So I'll take Ramjet's question, and I guess I'll ask it slightly differently.
I feel sorry for him.
Currently, it's a great time to buy. Those real estate agents want a commission. They're pushing their vendors very hard to get a sale. They're taking offers to them. The vendors are being discounting and relaxed. I consider it a pretty good time to be in the market, but what do you guys think?
So I might refer to Cam. Who's the most successful investor in the history of the world?
Was it Warren Buffett? He's a French guy.
Our French friend.
The Oracle of Omaha, Warren Buffett.
I used that joke 3 years ago, and these two have just run with it like it's their own ever since.
I thought it up.
And that's called teamwork. And what's one of Warren's most favourite sayings?
Be fearful when others are greedy, and greedy when others are fearful, which is basically the same principle that we use when we buy property. Is we buy counter-cyclical. So, and he frames it in a very simple way, and he's obviously a lot smarter than just throwing a single thing out and adhering to it every time. But once again, arguably one of the greatest investors in the history of the world. Rockefeller and a few other ones would be up there, but if we're looking at, and there's a WOD we've got, which is a workout of the day video on our website, which it's quite a complex little diagram I draw, which is called the developer's activity chain. We might repost it shortly over the next day or so you can have a look at it, but that explains exactly why capital city markets move, what supply and demand is, and how developers affect the market cycles more than anything else, more than, obviously population growth.
All of these things relate to, like Al was saying, when everyone's in the market and everyone's hungry and everything's red hot, is a bad time to buy because you're only paying more.
Yeah.
When you take away that demand and you've got fewer buyers, you can buy better and make on the upside when it comes through.
Yeah, that's right. So I'm sitting around thinking, when's the correction coming and how do I get into it and how do I take advantage of it? You're a bit late. What we should be looking at is what are the indicators that tell us, have we leveled out?
Yeah.
I can see everyone saying yes. All the indicators, I mean. So now's the good window, because if you get some growth coming out of it, we go back to where prices were 12 months ago, hey, you've had an enormous win, good on you, you bought at the right time.
Yeah.
So I might, we haven't had a question on it, but I got an email about something similar from a client today, and I covered it at a couple of presentations a fortnight ago in 2 or 3 minutes, and people said it was one of the most insightful things that they'd heard. So
here we go.
I don't know.
I don't want to.
Not a big note, but
fun and games. Think about the headline that you've read in the last couple of weeks that says the market is crashing or something to that effect, right? I asked the question and I said, so what does that actually mean? What are journalists that say that, or newsreaders? What are they actually talking? Sorry guys, tech issue. I just think we had a dropout. I'll pick up that point again. So we're talking about what a median house price is. And basically it's the middle value in a range of sales. So for example, if you had the cheapest sale on one end of the spectrum up to the most expensive sale at the other end of the spectrum, and you take one off each end until you get to the middle. So it's basically an indicator of market activity. So let's say that the market is crashing, is followed by some commentary about how Australian house prices have come back 10% in the last 12 months. There's not one market in Australia, there's not one market in Melbourne, right? There are different markets in multiple markets in different locations. So that's the first thing. It's not accurate to make a sweeping statement about the Australian median house price. Secondly, why the median house price has come backwards is twofold. Firstly, the two most expensive markets in Australia, being Sydney and Melbourne, are the ones that have come back from periods of growth. So naturally, that's going to shift more activity to the affordable end of the market. And secondly, because of all of the stuff we were just talking about a few minutes ago with regards to the lending criteria, if the median house price is, say, 800,000, very few people can actually borrow enough to be able to buy a property more expensive than 800,000. So if the median is a middle value, then naturally the middle value is going to shift downwards to recalibrate that middle value. So to summarise, just because the median drops doesn't mean that everyone's property has lost that amount of value. And secondly, I bought a property in the middle of the GFC. The median came back 10%. I made 100 grand in 18 months because by buying at the affordable end of the market, there was always market activity and always sales activity at the affordable end of the market, which gave me better comparable sales based on higher demand and so on. So just wanted to, I guess, put some context around what we're hearing in the headlines around median house prices.
Can I give you
and what it means?
A live example of, so if we think of a capital city as a triangle, there's lots of people down the bottom that can afford the bottom end of the market. There's only it's a pointy triangle at the top. There's only a couple of people that can afford at the top. It's probably about 5 years ago. A journalist from a well-known publication said to me, they wait in Melbourne to see when the top couple of sales get taken out of the median. And then they report the median in Melbourne has dropped by 20% because it sells newspapers, so the market's crashing. So they need some stats, and it's not lying what they're doing, they're just fabricating what's not really occurring. So this is how they get the shock factor in the newspapers. Because if you take the top 2 sales out of Toorak, well, you need to drop down a whole level to be able to get people to buy at that level. And that shifts the median way down. So they basically watch it and just go, when we get the top end of the market chop out, nothing changes for the average person. And as Michael said, it doesn't move at all. The top of the market will do that all the time based on there needs to be a couple of fat cats at the top who can buy property.
What else we got there, Oz?
So there was a question around where do we see the Melbourne market, and has that bottomed out as well?
I think Melbourne's pretty stable. Yeah, I think Melbourne's pretty good. I'm still buying Melbourne. So.
Indicators are that it's levelled out in terms of it's even now. What I'm looking at in terms of indicators that I like to keep an eye on are things like rental vacancy rate. I've talked about it a fair bit. Rental vacancy rate, it's jumped up a little bit to 1.7% from 1.4%. 3% is a balanced market, so we're still undersupplied. And we've got 327 new people per day pouring into Melbourne in terms of population. They've got to live somewhere. There's no new build starting, so I'm starting to get concerned about what's going to happen. It's sort of like just a pressure pot building that's going to, at some point, start to...
So HWL Ebsworth is one of the largest property legal firms in Australia, and we know them very well. They were saying they're doing about 1/3 of the settlements they were a year ago, 18 months ago. So if you think about it, the population growth is still cranking in there, but they're building and selling about 1/3 the amount of properties. This is new builds, so new builds. So you've got a build-up of undersupply there occurring based on the fact that people can't get money.
Yep. Keep the questions coming through, guys. I'm just refreshing to make sure we're getting all those questions after the dropout.
Where's Caesar? Has he got some more?
Caesar's disappeared for the last 15 minutes. But fire up, Caesar. Look forward to hearing what you've got.
Brad Hall's got one. What's Brad's?
Brad's there for complimentary value.
Oh,
it's great. He's chilling back in Thailand with a pina colada by the look of it.
I know Brad. Brad's an old friend of mine, and Brad actually sold a house, so I organised a property for him 10 years ago. It doubled and a half in value, and he sold that, and he's gone living in Thailand for 12 grand a year. So
hope the house build's going well, Brad.
Yeah, so it's not a tree change or a sea change; it's a big change.
Indeed. One that we might cover off while we're just waiting for some more questions to come through. There's a lot of talk at the moment around interest-only loans and converting to principal and interest on the back of the lending environment and the bank's calculators. So I thought I'd just share some insight on that. Seen a couple of articles in various publications in Melbourne, including the Fin Review in the last week or so, talking about just the $360 billion worth of loans coming off interest only into principal and interest. Yeah. Just wanted to, obviously big numbers create headlines, just wanted to put that into context for everyone. So a couple of key things here. Back in 2015, 40% of the loans against housing in Australia were on interest only. Come March 2017, APRA imposed the cap on the banks and said that you had to get it under 30%. Yep. So that's a pretty drastic drop. That's 25% reduction. By offering really cheap interest rates for principal and interest repayments, that happened pronto, and by October, so within 6 months, 7 months, all of the banks were down under that 30% cap. But interestingly, the APRA didn't lift that lid or that restraint until just before Christmas last year. So basically the banks had all met the criteria super quickly, and for 14 months that criteria sat there even though they were under the cap.
And there were some banks well under the cap.
Yeah. The 360 billion that I mentioned before, there are 9.5 million houses in Australia made up of total value 7.4 trillion. So if we want some big numbers, there it is. 360 billion only makes up 5% of the total asset value of residential property in Australia. So just a thing to remember, if you are on an interest-only loan and your principal and interest, or the interest-only period is coming up for renewal or expiry, best thing you can do is be prepared and be thinking ahead of the curve. Get your situation assessed, because there are some great refinance opportunities out there at the moment with all the talk for interest rates coming down and banks especially having fixed rates that are really competitive.
If you don't know a good broker, email Michael and he'll put you onto one.
Good broker is essential, definitely. Not just a good broker that's good at low interest rates, but a good broker that understands finance for investment. Very different.
Structure is very different.
Yep. And the other thing is the reason why it's important to, in fact, I'd encourage everyone that's on here, if you do have an interest-only loan, go and check out after we're finished when it expires. Because if it's in the next 12 months, you've actually got some time there to be able to adjust things, to be able to put you in a better position to be able to roll over to another interest-only period once the expiry comes up. And what I mean specifically by that is living expenses are one of the biggest things that can impact your borrowing capacity. And banks will want to see 3 to 6 months of evidence of your living expenses.
So you tighten the belt for that period of time?
Exactly right.
Yeah. Well, there's a bit of non-common sense, isn't there, with the assessment. So if someone went to Hawaii last month and then they go for a new loan, they say, well, your discretionary spend includes Hawaiian holidays, so you can't have a loan. No common sense saying you wouldn't do that if your loan repayments were due, would they? Yep. So that's where he's saying tidy it up a little bit.
And since December, when the cap got reduced, some banks, a very small number, mind you, have started to adopt some common sense, and they'll actually be far more lenient on one-off expenses like holidays or whatever it might be. So, buying cars, if you're talking to Cam. So,
did you say banks and common sense in the same sentence?
I said a very small number of banks. Okay. So the whole purpose is that's the reason why you want to use a good broker, because they will give you a snapshot across the whole lending market, as opposed to hoping that the bank that you've had a long-term relationship with is one of those smart ones, using a bit of common sense, and that you'll get a good outcome. So
on lending, Boz, there's a few banks that have eased up, and with the LVR, what can you pull at the moment?
So definitely the number of banks back in the game at 90% interest only for investment is increasing.
Yeah, it's been a while. It's good.
Definitely.
Mortgage insurance is a good thing.
Love mortgage insurance.
Pay it all the time if I could.
Why is that?
Using other people's money to get leveraging other people's money is the most powerful two terms you'll ever come across when it comes to investing. So Elle and I were talking about the other day, if we didn't have an understanding of how to use the bank's money, and what mortgage insurance allows you to do is get more of the bank's money. So you've got, while you might pay a little bit, you've got to be able to lend more, you've got more in your back pocket to use for your next deposit or for a buffer to hold your investment portfolio.
And I think at times it can feel like a big investment to buy your mortgage insurance, but if you counterbalance that against the growth a property might get, if it gets 5% in a single year, you've more well and truly covered what you've paid there and more. It's an investment that's
if anyone wants a detailed, written out example of why mortgage insurance is good, shoot through and we can organise one for you.
Do you want a short version now?
Short version now.
Short version now.
You have 30 seconds.
Look at that.
So let's say that your mortgage insurance on an affordable property is $9,000. Mortgage insurance on investment is tax deductible. So let's use some round numbers and say you get a 33% tax benefit on that. So real cost is $6,000. If you have enough to be able to put deposits onto each of 2 properties at 10% plus costs and pay 2 lots of net $6,000, that'll cost you $12,000 overall, compared to having one property with a 20% deposit and no mortgage insurance. So while it's more effort for the broker, another step of the approval that you need to get that the broker's negotiating for you, they're doing all the legwork, no extra effort for you. By having that second property, are you going to make more than $12,000 in the time it takes you to be able to grow another 10% in value? Absolutely. Yeah, sure. That's why it makes sense.
So the outcome of leveraging other people's money, utilising those two things together, is being able. Real wealth comes from holding the most amount of asset with the least amount of money out of your back pocket. So in that case, while there's more money out of your back pocket, you're owning a much larger portion of asset.
Cool.
Good. What else you got there?
I've just fired a question out there to see if there are any more questions based on what we've been through. Write them in the comments, guys. If there's anything in particular that you want us to cover off.
Have we missed any? Can't see that.
No, we've covered all the ones that are there.
All good.
Someone asked me on the phone actually one of my mates rang me on the weekend, said, are there any positives in the market right now? We talked about strong rental yields and so forth, and good buying when there's less demand. Yeah. Anything else that you guys would share while we're waiting?
I think good if you're buying your primary place of residence. Really good time to buy your own primary place of residence and move into it. While you might pay if you can negotiate well and get more for your own place, you can really negotiate hard and pull in a good bargain there. Our brother-in-law's just done that recently.
I think the positive would be if we get some first home buyers back in the market, investors back due to that rental growth, then we start to see a bottom-up push rather than, offshore people coming and buying property, dragging it up. We're going to push it up from the bottom.
Good point.
And I think that's a real positive we'll start to see.
We love some organic growth. That looks like it's it for the questions, guys. Thanks for joining us. Hopefully you've found some value out of that.
We'll see you next month.
See you next month.
We'll see you next month.